was April 1947 in Columbia, South Carolina. Bernie, great to see you today. Bruce, thanks for the honor. So you ready for the unveiling? Of course. And you've got a short thank you planned. Well, not exactly, Bruce. What do you mean? Well, you know, I always make comments about what's going on. You're not going to talk about what's going on in Europe, are you? Well, yes, I am, Bruce. You see, what's going on in Europe is very important now. You don't think we're going to have another shooting war, do you? No, Bruce. I think we're going to have a Cold War. The two people speaking then were Bernie Baruch. Bernie Baruch was the most famous financier from 1916 to 1950, where he advised numerous presidents and advised the US government on appropriate financing for both World War I, the Great Depression, and World War II. Bruce is Bruce Littlejohn. Bruce Littlejohn was Speaker of the House in South Carolina, where they were unveiling the portrait of Bernie Baruch. Bernie Baruch is the person who coined the phrase Cold War, and he coined it in his speech right then and there. And that speech is relevant because today we are in a new Cold War. And while it is in the early stages, this Cold War will impact economics and how things develop over the next couple of decades. This is our legal disclaimer. This legal disclaimer says that you need to consult with your financial advisors and accountants, and I am not offering any financial services today. It also states that the SEC considers anything I say advertising, but you can make up your own mind. Okay, first poll. Zoe? Okay, so we've got a split verdict. Half of you think it's going to be 1%, and half of you think it is going to be 1.5%. The Federal Reserve, in my opinion, runs the economic cycle. And what the environment looks like is leaving the 1930s and what the 1940s brought us. And what the 1940s brought us was actually fast economic growth, inflation, and lots of money supply growth. And I'll show you what I mean in a minute. Okay, here we go. Okay, from 2015 till 2020, the Federal Reserve actually tightened monetary policy. Did this by withdrawing money from the economy, and it did in a sneaky way by stopping to buy bonds that had been buying under quantitative easing, which meant that when the bonds came due, they repaid them and they were taken out of, the money was taken out of circulation. And this is, by the way, what the monetary base looked like in the 1930s, in 1936, 1937, when the Federal Reserve did a similar thing, because to solve the problems of the Great Depression, the US entered into massive quantitative easing at that point in time. And it was successful. It allowed the economy to recover 100% of what had occurred before. But when the Fed got worried about inflation, it tightened. And as a result, we had the recession within the Great Depression, which was a very nasty recession. Afterwards, the Fed allowed money to grow exponentially to support the economy and to support the economy and the war effort during World War II. As then, federal debt spiked upward. Federal debt today, if we were to add the deficit from this year, is approaching the peak of 1947, where federal debt approached almost 120% of GDP. We're probably going to be up above 115% by the end of this year. And what did the Fed do during World War II to prevent interest expense from eating the federal government alive when it needed to spend money elsewhere? It controlled interest rates. And that is what it's doing now and what it's likely to do over the next few years, to not allow interest rates to go up so the massive debt that the government has accumulated does not eat the federal budget alive and force a massive tax hike that would harm the economy. The big increase in interest rates occurred in 1948 when we had the famous Federal Reserve Treasury Agreement, where the Treasury allowed the Federal Reserve to once again raise interest rates. And by the way, the Federal Reserve's control of interest rates kept overall long-term rates relatively low until the 1950s. However, despite low interest rates, we had significant inflation during the 1940s, and the price level rose 78.6% over the decade. That 78.6% rise meant that the dollar in 1950 could only buy 54% of the goods it could buy in 1940. I expect something similar over the decade of the 2020s, as the federal government needs to inflate away the debt, which is the United States' preferred pathway on dealing with too much debt, which it has done multiple times in the past. And it needs to grow the economy faster. Thus, we need to have plenty of money thrown into the system to grease and lubricate the wheels. And if we were to look at what the Federal Reserve has done, the Federal Reserve emergency liquefied the economy, and I would expect that this amount of money will continue to rise over the next few years as the Fed continues to support the economy. And given what the Fed has done, the yield curve, which I consider one of the best leading indicators of the economy, is indicating that the economy is going to accelerate as the yield curve is starting to steepen, and looks very much like the steepening that has occurred before other recoveries. Next poll, Zoe. Okay, so the average here is 4%, with a significant number of you wanting I would say the average is closer to 3.25% because 20% of you think we're going to grow 2% this year. But let me give you my thoughts here. The U.S. economy is in a classic early cycle position. And unlike the 2008-2009 recession, the banking system is intact. And that is a critical factor when we look at the economy, that the banking system is not broken. Because when the banking system is broken, it dictates a slow recovery while the banking system repairs itself. Here's a graph of industrial production. If we look at the drop in the last recession, it was similar to the drop in this recession. However, the big difference is, while industrial production peaked in late 2007, it did not exceed its 2007 peak until mid-2014. It took 7 years to get there. Part of that was due to the need to repair the banking system, but the other part was due to some of the economic policies chosen by the Obama administration. And I would point out that they were different than the Clinton administration, which also faced a banking crisis. Yet, within 3 years, industrial production had exceeded its previous peak. So policies matter, and which policies an administration chooses do dictate the course of the recovery. Here, the likely recovery we'll see by June of 2021, which is less than 6 quarters from when the peak occurred in industrial production, that we will see industrial production make a new high. In fact, based on GDP Now from the Atlanta Fed, the economy is supposed to grow somewhere between 7.5% and 8% annualized in Q4, which will put industrial production just a few percentage points below its prior height. U.S. auto sales have done their typical recession where they got cratered and came back. I would expect a pullback in U.S. auto sales over the next few months before they sustainably move higher. Existing home sales, housing is typically early cycle, except when we blow up the housing market and the banking system. When we did that in the early 90s, housing did not recover till the second half of the 90s. When we did that in 08, 09, housing didn't really start to recover until 2012. What we had now was a flight from the city, which caused a 20% spike in existing home sales. This was matched by a spike in single-family home sales from the home builders. But as you can note from both these graphs, those spikes have started to roll over, and we expect housing demand to slow as those who moved to flee the cities have moved, and those who have remained will remain. And with the vaccine rolling out this year, the need to flee the city will diminish significantly by the end of this year. At the same time as demand is cooling, supply of homes will increase. This is both for existing supply of homes, and this will be for new homes that are being built. Single-family permits have risen back to peaks that we have seen in other housing cycles, and single-family starts are racing to catch up with permits. The reason this will probably look like a pullback in the housing market like the late 90s has to do with the millennials. The average millennial is 31 and a half years old. They are married at this point, and they are in their prime home buying years for their first home. And about another 3 to 4 years, starting in about the mid-2020s, they will be ready to buy the move-up home. But right now, they're buying starter homes. And as real estate brokers will tell you, any home between $300,000 and $600,000 today is hard to find. The other thing that you will see is they are the marginal buyer. They comprise over 50% of all home buyers for both existing and new homes. As a result, as interest rates recover this year, and we expect them to recover to somewhere between 1.5% and 2% by the end of this year as the economy recovers, that will slow demand for housing as well. I would note that a 1% increase in the mortgage rate on a 30-year mortgage is the same as a 13% increase in price. So between mortgage rates going up, demand slowing, and supply increasing, we expect a significant slowdown in the housing market starting later this year and going into 2022 as the housing market acts in its typical early cycle manner. Here's the home ownership rate. If you see those little red dots here, up near 68% on the right of the chart, that is where home ownership is and how it spiked due to the coronavirus drive out of the cities. As you will see, it's at the highest rate since the housing bubble back in 04, 05. Here's the other thing, home prices are at record highs, and in real terms, if we deflated this for inflation, you would see that home prices are approaching the peak of 2006, 2007 on a real basis. Okay. Oh, and by the way, for those of you who wonder, we think that the U.S. economy, we'll show you a few slides in a minute, will grow potentially north of 5% this year. And I'll explain why in a minute. Here's corporate profits. Corporate profits are at record levels. Typically, capital spending follows corporate profits. And real median household income has started to grow. Over the last 20 years, it's actually up about 7 to 8%. So the audience was pretty accurate in that. But over the last 5 or 6 years, that's where you've seen 100% of the growth. And most of the growth has occurred since 2016. That's my dog, as many of you know. And my dog wants two things. He wants to be taken care of and loved. And the American public has not really been loved until the last few years when median household income started to rise. And if we look at the data, what's happened is that about 4% of GDP got transferred from labor to corporations in terms of their profitability. And that occurred because we entered the WTO on top of having entered into NAFTA. And while NAFTA had some impact, it was really the WTO that had a massive impact, because the way the WTO was written so that corporations, large corporations, could gain access to emerging markets and have the ability to then relocate their plants from the US and perform global labor arbitrage. And that is what has kept labor share low and caused it to drop. However, in a democracy, ultimately, the majority votes. And thus, Donald Trump was not an anomaly. He was the product of really 20 years plus of the government putting in place policies that benefited large corporations at the expense of the average American. And only recently has the labor share of GDP started to rise. And I would expect it to rise in a jagged pathway. The US has a long history of populism, and I would expect that to continue to drive labor share up and to drive corporate share of GDP, corporate profit share, back down to where it was all the way from the 1940s, and we don't really have the data here, through 2000. This chart indicates that the consumer has done reasonably well based on net worth to income, but averages are deceiving. Almost all the increase in consumer net worth has gone to the top 1% of the populace in the United States. They have gained over the last 25 to 30 years, 7 percentage points of the overall wealth of the country. The 90th to 99th percentile, the next 10% basically, have gained slightly, but are sort of where they were back in 1990. So the question is, who lost? And the people who lost was the middle class that stood from the 50th to the 90th percentile. And as you can see, their share of the total wealth in the country fell from 36% once we entered into the WTO down to 29%. Or they gave up 100% of the 7% that the top 1% gained, because they were the principal victims of global labor arbitrage. This chart from Ray Dalio, just talking about the accumulation of the bottom 90% wealth versus the top 0.1% wealth. But what's interesting is the bottom half of the population has begun to recover from the depths of where they were. And this part of the population is the part that Donald Trump appealed to, and where you can see that they gained significantly under his presidency. And not only did they gain as a percent of overall wealth, but their actual wealth more than doubled. So let's talk about the government. The government has an issue with healthcare spending. The government spends over 50% of all healthcare dollars in the country, and I think it's inevitable that the government, in order to fund other needs such as defense and infrastructure, is going to squeeze healthcare. And while the healthcare stocks are happy that Joe Biden got elected, I'm not sure if they're going to be as happy 2 to 4 years from now, when the reality of what the Biden administration will have to do in terms of pricing and squeezing the healthcare industry in order to pay for everything else becomes reality. For example, the US pays significantly more for drugs than any other major Western economy, whether it's Germany, the UK, Canada, or Japan, or Australia. And I would expect the US to move drug prices to those levels. It's estimated that if drug prices were moved to those levels, it would eliminate anywhere from 25 to 40% of the pharmaceutical industry's profits. And there are other areas that could be addressed, such as medical devices, et cetera, to bring our pricing in line with pricing around the world. And given that we spend 18 to 19% of GDP on healthcare, and the government spends half of that, which is 9%, if the government was able to take that 9% to maybe 7% and save 2% and shove that into infrastructure spending, that would be a massive shift for the economy. Let's talk about public construction. Public construction spending relative to GDP has collapsed and needs to come back to where it's been. And we would expect a massive infrastructure program from the Biden administration this year. By the way, infrastructure is very good for GDP, has a positive multiplier effect, typically between 1.4 and 1.8. What that means is that for every dollar the government spends on infrastructure, we generate $1.40 to $1.80 in GDP. That's well researched and well known. And here's just overall investment to GDP. The government's investment into R&D has decreased, but where the government is now increasing investment in R&D is through DARPA and BARDA, and through defense, and through the space program. And we would expect there will be significant throw-offs from all those things that are going to come into commercial reality. For example, the microwave that we all take for granted today was created during the Apollo space program. As part of that program, the real issue we'll have is tax collection, and when are they going to raise tax rates? The question is not whether, the question is when. We believe that will be either a late 2021 once the economy recovers, or a early 2022 with an effective beginning January 1, 2022. We had advised numerous clients of ours who wanted to redo their estate plans to make sure they got them done before the end of 2020, as we expected the estate laws to change with the new administration. Okay. Next poll, please. Okay. So what we have here is, if we look at this, the median is, you think the market's going to grow 10% over the next decade, which is the long-term median result. The markets today look very much like the late 1990s. And we'll show you a little data on to show how it looks very similar shortly. But valuations are similar. The level of speculation is similar. And the number of companies that are coming public that have no revenue and no earnings, but are receiving large valuations is similar. That did not end well and resulted in a decade of low returns for those who indexed to the stock market. And in fact, in real terms, the stock market deflated for inflation, as reported by the government, did not exceed its 99 2000 peak until 2014. So let's start with this. This is a critical number. This is the amount of debt that yields less than zero. This relates basically to Europe and Japan, and it's greater than 25% of all the institutional grade debt out there. And as a result of the Federal Reserve keeping rates low, real rates are less than zero. That's good for the economy. That means that you can borrow, and if your profits merely rise at the rate of inflation, you should be able to repay the borrowing in depreciated dollars. Now, the problem you have when you manipulate interest rates to be so low, you drive valuations up using DCF models. Here's Tobin's Q. That's the ratio of assets to replacement value, which is at a record level. It has significantly exceeded its 99 2000 peak. Corporate equities to GDP similarly have exceeded their 99 2000 peak. And the only indicator that has not yet exceeded that level is the cyclically adjusted PE, care of Robert Shiller at Yale University. He's the same guy who came up with the Case-Shiller index. And this is a moving average of the 10-year earnings on the market. And the cyclically adjusted PE has now exceeded its 1929 peak, but has yet to exceed its 2000. We never know how high these things can go, but we do know that combined, they mean not necessarily good things going forward for the markets. And by the way, reflecting the massive run-up in the markets is the Citigroup Euphoria Index, which, as you notice, has seemed to have gone off the charts relative to 99 2000, which is quite interesting. And reflective of euphoria in the market is the number of annual IPOs. This, of course, excludes SPACs and direct listings, which would add another 50 plus to this, which means we've had 530 companies come public, worth quite a bit of money, which means we are almost 25% above, 25 to 30% above the number of IPOs at the peak in 2000. This data is from Stifel Nicholas, and what it basically is the 10-year S&P 500 annualized total return projected 10 years forward. So in other words, valuation, those three valuation statistics I showed you, if we combine that with the amount of assets allocated to equities, is highly predictive with a very strong R-squared and very high confidence interval of 10-year forward returns. Now, while all of you thought that the average return over the next decade would be 10%, these statistics indicate it will be closer to 0 to 2%, given current valuations. And while the market likely will have a reasonable 2021, although volatile like last year, the long term looks less good due to tax increases, inflation, and ultimately a compression in PEs as the euphoria goes away and the reality of many of these companies comes forward. There was a company, and we wrote about this, called Net 2000 that came public in January of 2000. And what happened, it came public at 20, which was above the indicated range of 12.5 to 16.5, went into the low 30s, and 2 years later declared bankruptcy. We think that a number of companies that have come public recently will follow the same path. Here's another critical number. and we expect this to have an impact too. This is the amount of committed capital to private equity funds. It's $2.8 trillion. It's almost 15% of GDP. Okay, so 73% of you say the US dollar probably won't rise this year. I would say that's probably a reasonable assumption for a lot of reasons, but mostly because we are in an 1890s world. The United States can no longer afford to allow other countries to drive the value of the dollar upward. An 1890s world means we're back to the great game of power from the late 1800s, where various countries competed for global influence. And it also means that each country must watch the value of its currency to not allow other countries to game the system to gain global competitive advantage, as has been done to the US over the past 25 years. Okay, this is what I call the world of yesterday, which was the G7 dominated the top 10 global economies. The world of today, the reality is the developed markets are smaller than the emerging markets, who have continued to grow at a rapid rate. And I would expect this to continue. One of the major issues has to do with Europe and the way they have constructed their economies. And I'm not sure if it's going to be sustainable. As you know, I believe that countries like Italy and Greece and Spain should reestablish their own currencies and return to something similar to what they had prior. Else, their current ability to continue driving their economies is limited. And this is the world of tomorrow. That's China, number 1. This is from the IMF data. The US, number 2. India, number 3. So 2 of the top 3 economies in the world are developing economies by 2030. We're not sure if China will be the top economy in the world at that point for a variety of reasons, which we will discuss shortly. For the US, there are a number of hard choices ahead and a number of economic myths that will need to be slaughtered. The first economic myth is that Smoot-Hawley, that infamous tariff, caused the Great Depression. There is no statistical evidence that it actually impacted the depth or breadth of the Great Depression. The main issues were massive overinvestment in capital during the 1920s, especially the late 1920s, where we built out the whole auto and electrical system in the United States. And once that was over, we kept building stuff when we didn't need to do it. At the same time, the Federal Reserve mishandled monetary policy in the late 1920s. And those two things, coupled with inaction on the government's part, led to the depth of the Great Depression. When Roosevelt came in and changed policies in the early 1930s, economic policies, the US economy staged a recovery such that by 1936, it was back at its 1928 level. So it recovered 100% of the drop that occurred in the initial portion of the Great Depression. And I would note that they did not get rid of any of the tariffs that were put in place by Smoot-Hawley. Okay, let's talk about the US dollar. US dollar versus developed market currencies are effectively flat. This is a long-term chart here. The issue has not to do with whether we're against the UK pound or the euro or what used to be the German Deutschmark. The issue really has to do with emerging market currencies. Emerging market currencies, as we moved into the final stages of negotiating the WTO in the decade of the 90s massively depreciated their currencies. And that gave them competitive advantage until about 2013, 2014, where their internal inflation drove their labor rates up in a number of those countries back towards making them lose all their competitive advantage. So what did they do? They entered another round of depreciation where they depreciated their currencies another 25 to 30% against the US dollar. We would note that on top of that depreciation, they attempted to depreciate their currency significantly in 2020. But the Federal Reserve stymied that by printing and putting into the system lots of US dollars, which offset the depreciation and caused the US dollar to return to the valuation against the emerging market currencies prior to their attempted devaluation. Now, here is the difference. If you saw this chart a year ago, what you would see is that the yen and the euro and the pound are closer to fair value than they were a year ago. And we're not too far off. Those currencies and the US dollar have fluctuated in a pretty well-known band, plus or minus 20% for the last 50 years. The issue has to do with the emerging market currencies. The Brazilian real a couple of years ago was over less than 3 to the dollar. It then went to 4 to the dollar. It is now 5.29 to the dollar. The Indian rupee also is down about 10% over the last year and has depreciated over the last 5 years significantly against the dollar. Given the reality of those economies, there's no reason that the US should allow imports from those economies without considering the impact of the drop in the exchange rates on the competition of US business against those countries. We expect that the US, along with Europe and the UK, will ultimately have to address this in order for their economies to grow faster, or what they will need to do is, and we think that will be part of the solution, return to the GATT, which will force a renegotiation of how trade works. While Donald Trump did things in an America First manner, he was not wrong about the problem, but he would have been better off if he had brought Europe in and the US and Europe had, as a united front, addressed this issue. The US faces what I call a whack-a-mole issue. If we cut off trade with China, what happens? They just move the plant into Vietnam and send us the same goods. So, what do the following things have in common? Chinese polycarbonate production, Nigeria chicken imports and supply, and Adidas 3D sneaker manufacturing. And the answer, of course, is they all use all the vowels. But the real answer that might matter to this group is China decided in 2017 it was no longer going to import polycarbonate from the rest of the world. It has no competitive advantage, nor did it possess technology in this area. It merely stole the technology and built plants between 2018 and 2020 equivalent to global capacity, 20% of global capacity, and then shut out imports into the country from the rest of the world. Nigeria imports a significant amount of chicken from Benin because it's cheaper to produce chickens in Benin than in Nigeria. But chicken is a staple of the Nigerian diet. So what did Nigeria do? It banned imports of chicken from Benin. Adidas took its 3D sneaker manufacturing and moved production to Vietnam, closing its US and German plants, with the goal that it will build sneakers in Vietnam and ship them back to the US and Europe. We're not talking about a plant here that requires people. We're talking about an advanced manufacturing roboticized plant that requires little or no people. There is no competitive advantage to putting this plant in Vietnam, unless the government's paying for the plant and giving you the land for free. The result of all this over the last 20 years means US industrial production in manufacturing specifically has yet to exceed its 2007 high. I would note the 2007 high was artificially driven by the housing boom. And when the housing boom went away, it went down below where it was in the recession of 01 to 03. Also, the other impact here of all of this and the WTO has been on US capital formation. US capital formation collapsed. If you notice from 2006 all the way down to 2010, it just went in a straight line down. The better way to look at that is to see that as the housing bubble that the Bush administration fostered in order for George Bush to be reelected. And as a result, if you took that out, what you would have seen from 2000 to 2010, it went down in a straight line. We then had some recovery, and it's only started to really recover back to where it was in the last 4 to 5 years. Let's talk about investment in manufacturing and the economy. Manufacturing is critical because it leads to increased investment, which leads to increased productivity, which increases long-term growth. As almost any economist will tell you, productivity is the key to fundamental, sustainable, long-term growth. And if the economy grows faster, by the way, it increases final demand faster, which means you need more manufacturing, and you get a virtuous loop. Okay, let's look at US labor productivity. While I don't agree with everything that Donald Trump did, productivity growth did sustain a significant recovery under his administration. And if we look at the productivity numbers, these are year-over-year labor productivity from the Bureau of Labor Statistics. And as you can see, productivity improved significantly. And one of the reasons productivity improved significantly is that he began to crack down on foreign countries importing goods into the United States, specifically China, because part of productivity requires the actual number of goods produced to go up. And if we look at what happened from effectively 2000 to 2016, and it's one of the reasons productivity sort of collapsed during that time frame, is the number of physical goods the United States produced dropped. And when the number of goods produced drops and the amount of labor increases, it's kind of hard to have good productivity numbers. The US actually produces less than 50% of the goods it consumes. Prior to the WTO, we produced over 80% of the goods we consume. If we were to fix that issue, we would drive long-term productivity growth and long-term economic growth in the economy. Here is GDP growth per capita. This normalizes for population growth. As you can see, GDP growth per capita actually was worst under the Bush administration, because under the Bush administration, we effectively exported 5 million manufacturing jobs. For every manufacturing job, there are 5 to 10 other high-paying jobs. So we effectively exported 25 to 50 million high-paying jobs to other countries. And that really hurt GDP growth per capita. It also was one of the reasons median family income went nowhere. It improved somewhat under the Obama administration and improved again under the Trump administration. I have left out 2020. 2020 was a pandemic. If we hadn't had the pandemic, we would have had a recession in late 2021 going into 2022. But because the pandemic occurred before we rebuilt inventories, it had an impact on the economy. It's one of the reasons I think we're only going to drop 1.7% this year. And by sometime the middle of this year, we will have exceeded our prior peak. Now, all is not glum for the U.S. because the U.S. remains a R&D powerhouse. We still spend more on R&D than any other country, although China is catching up. R&D to GDP continues to move upward. And gross fixed capital formation is recovering as a result. And U.S. manufacturing investment actually appears on an upward slope. And I would believe that after the recession is over and as we enter into expansion over the next couple of years, manufacturing investment, especially as we look after the U.S., will move back towards the norms of where it was prior to the last 20 years. Here's industrial equipment investment, which actually took off and was getting ready to go to new heights and has stabilized relative to GDP. And here's IP investment, which reflects R&D investment. And IP investment has continued to go up. So I would expect that if we were to start to require things to be built here and things not to be done overseas, you would see significant economic growth. And it would require putting an end to things such as Adidas piloting 3D manufacturing plants here in the US, only to take advanced 3D manufacturing technology and put it in Vietnam. And we expect the government to move down that path and reimpose many of the technology export controls that existed during the Cold War with Russia. Economic growth is path dependent. A nation's allocation of capital and labor determines future economic growth, maximizing short-term growth and profits, but does not necessarily maximize long-term growth. And if we look at the US, it appears we have the beginnings of a national economic policy, and I would expect the Biden administration to add a national focus on infrastructure to all this put in place by the Trump administration, and continue to evolve a national economic strategy that will cause the US economy to grow faster. Faster economic growth is not inconsistent with the level of debt to GDP. There is no statistic that relates debt to GDP to economic growth. There is some statistics that relate government spending to GDP to economic growth, but there are none that actually show that if you have more debt, you grow slower. And so the years after World War II show that. And if the US were to require more manufacturing to be built here and to invest in infrastructure, capital investment into the United States, that would go a long way to causing the economy to grow faster, regardless of the level of national debt. Laura D'Andrea Tyson in 1993, the head of President Clinton's Council of Economic Advisors, stated, "The composition of our production and trade does influence our economic well-being. Technology-intensive industries in particular make special contributions to long-term health of the American economy. A dollar's worth of shoes may have the same effect on the trade balance as a dollar's worth of computers, but the two do not have the same effect on employment, wages, labor skills, productivity, and research, all major determinants of our economic health." Over the last 20 years prior to the Trump administration, we allowed and encouraged U.S. corporations to move high-tech industries outside the United States. The government encouraged companies to move manufacturing plant outside the U.S. We think that that is over. We think the country will move to have all this brought back here. The beginning is having Taiwan Semiconductor, who is now building an advanced semiconductor manufacturing plant in Texas, right next to Intel's semiconductor plants. And I think that's the beginning of a move to have all of technology produced here, which will include all the advanced materials that we need for technology, because technology without the advanced materials doesn't exist. Overlaying this is a Cold War with China. And while Henry Kissinger has said, we are only in the footsteps and we're not there, I believe we are in a full-blown Cold War with China. The Chinese believe that they have become the dominant economy in the world and will dominate the next 50 to 100 years. That is only going to happen if the United States lets them. If the US were to put together an economic policy similar to what it did after World War II, and which it followed through the 1980s under Ronald Reagan, it would change the direction, because a nation's choice of how it allocates labor and capital determines its future economic growth. So while the last 20 years have been difficult for America, the next 20 years are likely to see faster growth and faster inflation, and the average American see a better tomorrow. Thank you. I'll take questions now.
Okay, we have a question from Newell. I'm just going to, Paul, do you see key economic comparisons to gross output rather than GDP? And do you think this will result in different economic conclusions?
Okay, so that's a really good question. Okay, so for those of you who don't understand the question has to do with gross output versus what is gross national product. It has to do with how you define a country's economy, okay? And the difference between GDP, gross domestic product, and gross output is, in gross domestic product, we don't try not to double count things along the way. And it also depends how you view government spending. But for example, we're looking at different layers. I don't think it's going to matter whether we're looking at gross output or gross domestic product. I think that the conclusions are fairly similar because the fundamental drivers of what I would consider productivity growth in the economy are the same, and it doesn't matter how you measure it. So I think that gross output is going to grow faster. So if we were to look at gross output in the US prior to the 09 through 2016 period, gross output grew at like a 7 to 9% rate in terms of dollars, but then it slowed and only grew at about a 5% rate. And I would see that gross output number growing faster, which will be part of how we're going to deal with the national debt, because we'll have inflation plus actual economic output growing.
Chris Kroll asks, should we expect major tax change to reallocate wealth?
I would expect that taxes will rise on the top 1%. They will eliminate the estate, well, I would say eliminate the estate exemption. They will bring the estate exemption back from the 11.5 million per person back to 5 million. And I expect that taxes in general will go up on corporations, The belief, at least on Wall Street, is the effective tax rate won't go back to 35%, but the effective tax rate will go from 21 to 28%. And for technology companies such as, Google and Facebook and Amazon that have really played this, international tax game of trying to locate in low tax jurisdictions while putting revenue in other tax jurisdictions and then showing they're not making money in the high tax jurisdictions. I think that game's going to go away. And there's going to be an international tax treaty that actually taxes them. By the way, that will impact a number of pharmaceutical companies that have operations in places like Ireland and elsewhere, which are low tax jurisdictions.
Okay.
Next.
Okay. Adam Stern, in a zero rate or very low interest rate environment, wouldn't that keep money invested in the stock market, potentially artificially keeping the stock market / company values up?
Not necessarily. Okay, valuations and interest rates are not statistically correlated. You have what I would call, what's the right way to put this? Sometimes they are and sometimes they're not. Okay, low value valuations today are well above. So think about this. The Federal Reserve is artificially keeping interest rates down. But if you go back to World War II, which was the last time we kept interest rates down, valuations were much lower than they are today. If you go back to the 1950s, valuations were much lower than they are today. As inflation heats up, I expect there to be pressure on PEs, regardless of where the Fed has short-term interest rates. And you'll see, I believe, that you're going to get valuation compression. Valuations from these levels typically compress within, last time, within 10 years, they go from being well above average, and you can look at this from a number of things, to well below average. So if we go to the mid 1960s, last time valuations were sustainably high. By the mid 1970s, they had cratered. If we go from 2000 to 2008, valuations had cratered. If we go from 1929 to 1932, valuations had cratered. So the history of the market is that valuations can crater regardless of where interest rates are, because valuations are a function of confidence and of profits.
Okay, Michael Golden asked, was the 1936 recovery similar to this current situation in which the split in wealth allocation in equities were exacerbated?
Okay, so if we go back to, I'm not quite sure what you mean split in wealth. Those are two different things. If we do look at wealth in the 1930s, there were significant differences in wealth because clearly you had at one point 25% of the country didn't have a job, right? And people wanted jobs. So the government basically fed the people and housed people who couldn't get a job elsewhere until the economy recovered really during the late 1930s, late 1940s. If we look at so valuation in the markets, the valuation in the markets were below where they currently are, even though interest rates were extremely low. I think that answers the question, right, Georgie?
I think so. I'll check with Mike, I want to make sure, but I'll go to the next one. Bob Zecca, given that 2020 may have China as the #1 economy, do you think the renminbi would be overtake the dollar to be the world reserve currency?
Well, I don't think the renminbi is going to be the world reserve currency anytime soon for a variety of reasons. Do I think that there'll be more global transactions? Yes. But I don't think it will be the world reserve currency by 2030. And the reason why is the US has really run an open economy. And we've allowed the dollar to be used around the world as a reserve currency. And it's been in our interest to allow this and in other countries' interest to use it as a reserve currency. The issue with the renminbi is, given China's actions in the South China Sea and its other actions around the world, it looks more like Soviet Russia from 1948 to 1970 than it looks like something that the US did during the same time frame. And I think that countries, while they will transact in renminbi for Chinese goods, are unlikely to use it as and allow it to replace the dollar as a reserve currency. Now, that's not to say that the dollar will stay as preeminent as it has been, but what I would say is the US dollar is the best house in a bad neighborhood.
Okay. Louise asked, how does the US stack up to other economies in terms of labor, energy, and infrastructure?
Okay. So, as those of you who received my newsletter know, I managed to sneak off to Turkey last summer for 2.5 months, which I would highly recommend. But the one thing I can tell you when I was in Turkey is their infrastructure was not crumbling. They had built numerous brand new tunnels in Istanbul to move the traffic around. Istanbul is a city of 15 to 18 million, depending on how you measure it. They built brand new highways all over the country. I was on a beautiful new 6-lane highway that had been opened a few years ago. And they built tunnels right through the mountains, just like in Switzerland. In fact, I traversed a tunnel that was 3 miles long through a mountain. So I would say that US infrastructure is not close to where it should be. We need to invest in our roads. We need to invest in our airports. We need to invest in our rail infrastructure. We need to put in a whole charging infrastructure for electric vehicles. We need to invest into our electric infrastructure in order to support that. And we need to invest into another critical part of that infrastructure, which is our educational infrastructure, and revamp it in a way that it produces the people who can support everything else.
Okay. Moore Shankel asked, how do we not let an economic Cold War with China devolve into a real world war?
Okay. The history of rising power versus existing power, about 50% of the time ends in a shooting war, and 50% of the time does not. It is a flip of the coin. China is not ready to challenge us directly on a military basis for at least another 5 years. But I think that the probability of having a shooting war in Southeast Asia is better than 50-50, as we all know. There are several 100,000 Indian troops up in the Himalayas facing off against several 100,000 Chinese troops, and they had an altercation last year between the two troops where they fought a brief battle, and it was a stalemate. China's been extremely aggressive in the South China Sea. China is threatening Taiwan. China does not currently have the capability to invade and take over Taiwan yet, but I would not be surprised if they attempted to do that in the second half of the 2020s. And the US might be drawn into a war over Taiwan. The US has realized this, and this is part of the reason we are moving technology back here. And we likely will position more and more assets in Asia, whether in Japan or in other countries, so that we can stage the assets there so that they are close to what we believe will be the next conflict. We have to remember we fought the Korean War in the 1950s. We fought the Vietnam War in the 1960s into the 1970s. We fought a war in Afghanistan. All those wars were in Asia. So I would expect the next shooting match to be in Asia, would be over some third country. It would not be directly the US attacking China or China attacking the US, but I would expect that there is a high likelihood that we will have a shooting war at some point in the future. It's one of the reasons that the government has doubled the amount of R&D spending into defense assets, has moved to develop hypersonic weapons, has moved to develop unmanned vehicles, has moved to develop a protective shield that is actually protective, unlike the shield back in the Reagan days that can shoot down hypersonic missiles. So I think that there is a lot of concern on the US government's part, and they are preparing us for a potential shooting match in Asia at some point in the second half of the 2020s, because by the time you need the stuff, you can't develop it.
Okay, Charles Catrone, do you expect individual stocks to do better than stock indices over the next 10 years?
Yes, I think you're entering a period where actual stock picking is going to outperform indexing. These go through periods back and forth. If you go to the 80s, it was a great period for stock picking, and so was the first part of the 90s. And then from 95 to 2000, indexing won. From 2000 to 2013, stock picking beat indexing because the index went nowhere for 13 years. And so I think you go back and forth between the two. Indexing has won over the last decade, especially because you've had effectively the top 5 to 10 stocks in the S&P 500 dominating all returns, regardless of valuation. And I think that that's going to change. You kind of have a nifty 50 like you had back in the 70s right now. And so as that changes, I think that stock picking is going to outperform indexing for the next decade.
Hey, Bob Jarvis, is there an equity pullback? If there's an equity pullback, where do you think the investment dollars will move?
I think in an equity pullback, the investment dollars are going to move into, likely move into value stocks and likely move into emerging markets. Both those areas, and when I say value stocks, I mean value stocks globally. Both those areas are levered to accelerating global economic growth. Value stocks in the US and value stocks overseas are levered to that. And I would expect the global economy to accelerate, especially in the second half of this year. And those areas are both levered to an accelerating global economy.
Charles, what do you think of modern monetary theory?
MMT, or modern monetary theory, is just a fancy name for QE. It's a fancy name for financing the government using the central bank. It's been done multiple times in the past, has a multi-hundred-year history. It's nothing new. The result, ultimately, has typically been inflation, because you're producing more currency than goods. So ultimately, it feeds into inflation.
Okay, Richard Richardson. Doesn't the Belt and Road Initiative supported by Russia essentially guarantee their future dominance?
Okay, you mean Belt and Road Initiative supported by China, because that is China's Belt and Road Initiative. And does that support their dominance? Not necessarily. This is no different than the foreign aid that the United States has put in place. And in fact, the US has, through the World Bank and some other institutions, is starting to mount a counteroffensive where we finance some of these projects and we're forcing international standards on some of these Chinese projects. And for example, countries such as Malaysia, which got concerned about China having such control, basically canceled these contracts. There was a change in government, canceled the contracts and renegotiated them such that Malaysian companies have a significant portion of the contracts. So yes, this is just the same as foreign aid by the US. It is their attempt to expand their influence around the world. And the way the US will counter that is to grow its economy faster, to provide more money so that it can spread the money around the world. Georgine.
John Nillen, what role, when, and how will cryptocurrencies have a material influence on global economies, currencies, and policy decisions?
Okay, cryptocurrencies already are having a major impact. As you know, within the last couple of weeks, the OCC, that's the Office of Controller of the Currency, actually sanctioned the use of digital tokens and blockchain in the banking system. And I think that is the beginnings of legitimizing cryptocurrencies around the world. You've also had the SEC has allowed companies to hold Bitcoin on their balance sheets as an asset. I'm not quite sure if they'll hold them as ultimately those will be considered cash and cash equivalents. I think what will happen is they'll be considered investments similar to other types of investments like gold. You can buy gold and hold it on your balance sheet, but you still have to sell the gold in order to turn it into liquidity. It is not quite cash, it's not quite treasury bill, and selling a couple $100 million in Bitcoin is not the same as selling a couple $100 million in treasury bills or bonds.
Okay, Charles has we have another wealth distribution. Is the wealth distribution problem the top 1% or the top 0.1%, given technology leaders' wealth?
Well, if we were to take out the top 0.1%, it is the top 1%. Really? Okay. The top 0.1% controls a significant share of the assets in the country, but the next 0.9% also controls a significant portion of the wealth in the country. And I think it is really the top 1%. And really, top 1%, you're really talking about people who are making, let's say, over $500,000 or over $1 million, well, maybe over $1 million a year at this point.
Beacon is the premier executive networking organization serving the Mid-Atlantic region. To learn more, go to beaconforlife.org.